Gold, an investment that has stood the test of time. It's a symbol of stability and wealth. But how do you invest in it without actually buying or storing physical gold? That's where the SPDR Gold Shares ETF, also known as GLD, comes in. But before we get to that, if you're new here and you never see my channel, my name's Elliot and I upload videos about investing, the stock market, and I do updates on my own portfolio, which is on the Robinhood app. So if that's something you enjoy, please consider subscribing. I upload videos just like this every 2 weeks. GLD is one of the largest and most liquid gold ETFs in the world, making it a great choice for investors who want exposure to gold. Here's how it works. 1. GLD is backed by physical gold stored in secure vaults, mainly in London. Each share of GLD represents about 1/10 of an ounce of gold. 2. The ETF tracks the spot price of gold, meaning when gold prices rise, the value of GLD rises and vice versa. 3. It's traded on the stock market like any other stock or ETF, so you can buy and sell it easily during market hours. Now, why choose GLD over physical gold or other gold funds? Simplicity. You don't need to worry about storage, security, or insurance. The fund takes care of all that for you, but there is a catch. The expense ratio is 0.40%, which is a bit higher than your average equity ETFs, but reasonable for a commodity fund. So why invest in gold in the first place? Gold has a few unique characteristics that make it appealing to investors, especially during uncertain times. 1. Inflation hedge. Gold tends to hold its value over time, even as the purchasing power of paper currencies decline. For example, during periods of high inflation like the 1970s, gold prices soared. 2. Portfolio diversification. Gold can help balance your investments because it behaves differently from stocks and bonds. When markets are volatile, gold often holds steady or even increases in value. 3. Safe haven asset. During crises, whether geopolitical conflicts or financial meltdowns, investors flock to gold for stability. Just look at how gold prices surged during the 2008 financial crisis or the early stages of the COVID-19 pandemic. However, gold isn't perfect. It doesn't generate income or dividends like stocks or bonds. Over long periods, gold returns tend to lag behind equities. So it's not an investment that builds wealth on its own. It's more of a defensive asset to protect your portfolio when the going gets tough. If you're considering gold, you've got a few options. Let's compare GLD to other ways that you can invest in gold. 1. Physical gold. This includes gold bars, coins, or jewelry. The advantage is you own the tangible asset, but the downsides are significant. You'll need to pay for storage, security, and insurance. Plus, selling physical gold isn't as easy or as quick as selling GLD. 2. Gold mining stocks. These are shares in companies that mine for gold. They offer the potential for higher returns since they are tied to both gold prices and the success of the mining company. But they are also more volatile and risky. 3. Other gold ETFs. GLD isn't the only gold ETF out there. For example, iShares Gold Trust, ticker symbol IAU, offers a close product with a slightly lower expense ratio, but it's less liquid than GLD. 4. Gold futures. These are contracts to buy or sell gold at a future date. They're not for the faint of heart. They require a lot of capital and are highly speculative. GLD stands out for its simplicity, liquidity, and the close tracking price of gold. If you're looking for a hassle-free way to add gold exposure to your portfolio, it's a solid choice. So, is now a good time to invest in GLD? Let's look at a few factors driving gold prices right now. 1. Inflation and the economy. Inflation has been a hot topic lately. If it remains elevated, gold prices can benefit from the hedge. 2. Federal Reserve policy. Higher interest rates tend to hurt gold because it doesn't pay interest or dividends. But if the Fed starts signaling rate cuts, gold could rally. 3. Geopolitical uncertainty. Events like the Ukraine conflict or tensions in the Middle East often push gold prices higher as investors look for safety. Right now, GLD is trading around $241, and it's up over 69% over the last 5 years. It's worth considering if you're concerned about the market, volatility, or economic uncertainty. But instead of trying to time the market, think about gold as a long-term diversifier, a small piece of your overall portfolio, not the centerpiece. One question I get a lot is, how much gold should I have in my portfolio? Most experts recommend allocating 5 to 10% of your portfolio to gold or other commodities. Here's why. Less than 5% in gold won't make that much of a difference during market downturns. More than 10% and you're sacrificing growth opportunities from stocks or other investments. Ultimately, the right allocation depends on your risk tolerance, investment goals, and how much protection you want from inflation or economic uncertainty. GLD is a fantastic tool for investors who want simple, efficient access to gold without the hassle of physical ownership. Whether you're looking to hedge against inflation, diversify your portfolio, or prepare for uncertain times, it's worth considering. So if you enjoyed this video, please take the time to give it a like, subscribe to the channel, and let me know in the comments below. What's your thoughts on this ETF? And are you invested in gold right now? And we'll see you next time.